morning, everybody, and welcome to the Fred Report Technical Market Conference Call for July 21st, 2011. Hope everyone is enjoying the summer heat. We've had our two hottest days of the year here in Georgia. I can tell you all with great confidence that August is going to be much cooler here in Georgia and very pleasant, probably in Florida and the whole southeast because I leave for Los Angeles and Seattle and Portland at that time, where we will probably have a heat wave there. In any event, let's get into the conference call here. Jeff Garbaz is with us, but he's traveling, so we may have a slightly shorter call. First of all, the stock market. We've been saying that the indicator setup is the best we've had all year for a rally. This is still the case. Obviously, there are some headwinds, but we would consider that our target of 140 will be basically confirmed on the spider as long as we close above 133.25. We're about $1 above that today. So if we hold this, it looks to me like we're on the way here. We think that the spider, which previously had a high of roughly 137.18, can make it to at least 140 and possibly to 141 on the summer rally. And so we're pretty bullish here, and we think we've got through the end of July and quite possibly through the end of August as well. Then we're going to have to reevaluate some stuff. There are some headwinds here, but the biggest headwind from a technical perspective is the percent bears investors intelligence numbers keep going down. Our last number was in the 21s. This is a bad number, and this suggests that if we keep this trend up, that after this summer rally, we may actually fall off into the fall. So when we get up around 137 or so on the spider, we do think we have more, but that's when I would start to look and adjust stop losses and such, just in case we're off by a little bit. And speaking of being off by a little bit, we never did get that second position that we wanted to have in the OEF at 58.03. The low was 58.05. That's part of the fun of trying to run a list that way and why we're a little bit more concerned with macro commentary. But for the purposes of the list, we will put in today after this conference call that if the OEF gets to 61, we will remove it from the list and take a successful trade there. Intermediate term, it can go higher, 62, 63, but because of the way we run the list and because we have to exit at the close or at a specified target price, and not just intraday when we would like to do it, we will put that in at 61. We've had some questions on sectors, so I want to get into those here a little bit. The first one is XLE still is our favorite sector for all sorts of reasons, mostly summer rally type of behavior and in the commodities, and it looks like oil's getting ready to go, and we'll discuss that in the commodities. But this sector is acting very well. We think that this has a possibility also as a sector of leading into the winter. The two most favorable seasonal times for oil are the summer driving rally time, which usually ends in September, and then November, December, January are also very favorable. So we're likely going to stick with this as an overweight. We also, when we look at some of these big energy names like Chevron and Exxon, they are coming out of giant long-term bases and have the potential for an awful lot of upward movement. So we're very happy with those names as well. For traders, we will probably put ExxonMobil in to remove from our trading list at 86, but we will remain long that in the sector review. The stock could have targets as high as 88 to 92 ultimately by the end of the year if energy goes as I think it could go. We've had a number of questions about technology. Our favorite tech stock also is the one that reacted the best to earnings, which is IBM. We were on the fence in the last sector review on whether we should upgrade technology to an overweight. We have come down to leaving it as a strong equal weight, mostly because of the over-owned status of this. And I think you're seeing some of that in stocks like Apple and Intel. They've had great earnings, they've gapped up, and they've sold off, which says a lot of people are actually selling these on the earnings. So, for my money, technology looks very, very good, but it's still an equal weight. we would be looking actually at more of the smaller, more interesting tech names and not necessarily the big ones where we think that over-owning is in. We had a question from one of our subscribers, very good question, on the transports. Transports are still leading this rally, and they just got a new daily stochastic buy signal. They've made all-time highs recently. So while we're happy with while we're happy with the transports, we want to watch the interplay between transports and energy very carefully here. If they start to weaken as energy rallies, that'll be a sign that this rally may not have super strong legs into the end of the year. Transports and oil have often rallied completely in conjunction. You just have to look at 2007 to realize that there is not an inverse correlation in a strong economy. One of the things that we will be using to sort of judge whether we think we have a stronger economy is if transports and energy can lead this thing up in the next couple of months. We note when we look at the transport, some of the stocks like Federal Express and UPS actually look better than the transports, and some like CSX look a little bit worse. It's a mixed bag here with those. One of the headwinds for the market, I think, here is that it's going to be very difficult to see them doing a lot more economic stimulus into 2012. We all have heard that the third year of a president's term is the best year for stock prices. One of the reasons for that has been that the government generally does all sorts of stimulus to try to ensure re-election. In this case, I don't think they're going to be able to do that with the debt ceiling and all the hoorah we're seeing about that. I just don't think the Republicans are going to propose a lot of stimulus, and the Democrats probably won't either, and I don't think a lot of it would pass. So this may not be the best year of a president's term in this case, and we may run into some headwinds after this summer rally is over. But as I say, right now, indicators support much higher prices for this summer rally. We note that the stochastic pulled down to the 30-40 area and could head back up into the 90 area before we have any problem on the daily stuff. And the weekly stochastics are still advancing, and breadth looks good. Everything is looking pretty decent here, and I sense a little bit of skepticism right now. My real concern is around the end of July, when it looks like we get this debt ceiling thing passed. We may see some sell-off there. So we're bullish on stocks. We're going to be a little bit careful, though. In terms of the bond market, the TLT is acting really kind of lousy, and if it starts staying below 95, we think it's going back to 93.60, 93.50. If it breaks that area, it can test 88 on the TLT. This is our preferred interpretation of it. It just doesn't look like it's gonna make it, frankly. We've had a long-standing target of 98 to 100 on TLT. The high so far for the move is 97.90. That has basically worked, but it's still actually the lower end of the range, and I found when stuff gets into the lower end of my ranges and doesn't make it into the higher end of the ranges, it's actually much weaker than we thought. So advisors should be looking at laddered portfolios and all that sort of stuff. And don't forget, LQD, corporates, municipals, and stuff look much better than the treasuries at this point. They have for a couple of years. I'm not sure why that is, but it may be something to do with this debt ceiling business. But that's where I would be putting bond money, and I'd be making laddered portfolios for clients should we do that, should you have to buy bonds. In terms of the commodity markets, DBC is now steadily above 30 to 30.50, which is where we were looking for it to go. Much above 31 here, targets new highs for it. We note that the USO oil has recovered, and anything much above 39.40 would target 43 where that gap is, and we think that's going to work out okay. We actually are very positive on oil. The only thing, oil has a little bit of a head and shoulders bottom, but the right shoulder is lower, not higher. However, if you look at ExxonMobil and Chevron, their right shoulders are higher, so the stocks actually look a little bit better than the commodity does, and that's fine since most of you are involved in the stocks. I'm going to take a quick look at some stocks now.